News Live.
Welcome back to Trading Day. Well, get this, one of China's biggest financial institutions is offering zero-deposit home loans for off-the-plan apartments in Melbourne and the Gold Coast. It comes as Australian regulators try to tighten lending standards to cool the property market. For more on this, we're joined by Andrew Fawell from Bella Real Estate, live from our Melbourne studio. Andrew, zero-deposit loans, this sounds extraordinarily risky, doesn't it?
Well, look, it's adding a new dimension to the marketplace, but in obviously an oversupplied marketplace, developers are looking for other avenues to move their stock and offer a point of difference to the marketplace to be able to sell their product.
Who's behind it?
Well, it's obviously there's an insurance company here, and you know they've obviously got very big balance sheets and looking to redeploy their capital, and obviously they see that as an avenue to lend money to a marketplace that certainly is, in their eyes, very secure and safe with a great political environment.
Do the banks own the developments, do you think?
No.
We've seen the major banks and AMP really working to tighten investor lending by raising interest rates. So would it be right to say that this is basically at odds with efforts by Australian regulators? And is there somewhat of a moral hazard here?
Without a doubt, it's obviously, you know, there's been tougher parameters from the finance point of view put in place by the Australian banks in order to try and put the brakes on the Australian property market, specifically in Sydney and Melbourne, and obviously being entrepreneurial, the Asian Chinese market will look at ways of obviously getting around that and continue the flow of funds into the Australian marketplace. So they have their own set of boundaries that they're prepared to work within, which don't necessarily subscribe to what we're trying to achieve here locally.
I wanted to get your thoughts on it. I'm wondering if you could just elaborate on your own personal view. Do you see this as a good thing or a bad thing right now?
Look, I think it's a transitional part of the marketplace where you have got an oversupplied marketplace, which naturally there's people committed to large projects where they have to be able to sell their stock, and obviously if they're trying to attract the buyers that are in the marketplace at that point of time that have a massive amount of choice, then they have to come up with compelling reasons why they should obviously participate in their particular project. So this is just one way of that happening. There's multiple other avenues that they're using as well, rent guarantees, buyer rebates. There's a whole host of other avenues that they use in order to try and attract potential buyers. But you know, my opinion is that ultimately the market will sort out all of these developments and developers, and the project will have to stand on its own 2 feet without what I consider some sort of artificial engineering to attract buyers into their projects.
Would you expect to see a clampdown on this type of lending behaviour, though? Do you think it's time that regulators start maybe having a look at offshore lenders as well?
Well, look, I think that, you know, ultimately we're now in the international spotlight, so if you want to participate in the international marketplace, you have to understand that those international markets have a greater appetite for risk. You know, with the population that they're involved in, they have to take risk in order to get ahead. So they see Australia as a low-risk environment where they are prepared to take higher risk because they believe that redeploying their capital here is a much safer bet than necessarily having it invested locally.
And quality of life and access to quality education, obviously hugely important for a lot of offshore investors as well.
Look, it's one of the most compelling reasons, and I think there's a lot involved in, you know, speculating on why they're investing, but one of their greatest draw cards is that education is the #1 priority to the Chinese marketplace, and they want their children to get a better education, therefore an opportunity for a better quality of life. And naturally, with the pollution, etc., that you find in China and the stable political environment, there's a lot of compelling reasons for them to invest their capital here for the future, and they are always looking at the future.
And you really have your finger on the pulse, I guess, when it comes to looking at these issues. As I understand it, Chinese buyers spent about $12.4 billion on Australian residential property last year. What are some of the other reasons why Australia is so attractive for offshore buyers, especially given, I guess, renewed worries about a cooling in some of our core markets like Sydney and Melbourne?
Well, I think that, look, they're not looking at the immediate price here today. What they're looking at is that they are making money in their current environment. Their political landscape is not necessarily as stable, so they are concerned about preservation of capital, so the return is not necessarily the primary focus initially. So they want to redeploy their money so it is in a safe environment, so for the future they will be able to preserve that capital. And obviously currently with the exchange rate, with the dollar where it sits, our property still seems very cheap, specifically in Melbourne. You know, it's sitting at a 20-30% discount in their eyes, so regardless of where the market sits, it's still attractive in their eyes relative to their own local marketplace in similar capital cities.
Can I get your thoughts on some of the broader fundamentals, I guess, influencing the Australian property markets at the moment? You're at the front line. Are you seeing any impact of these moves by the bank to curb investment lending and other regulatory measures? Is it having an impact?
We definitely are seeing a direct impact, and I guess obviously specifically the investor component, which is requiring a greater proportion of equity to go into these purchases. Obviously young couples, young investors trying to save a 10% deposit is a feat in itself in today's market. So if all of a sudden the deposit rates become 20 or 30%, they have to save 2 or 3 times the amount, which is not readily achievable or attainable to the average owner-occupier or investor. So yes, that's definitely had a direct impact and will continue to do so. And
when you assess the landscape overall, do you see an elevated risk to the downside for prices in Sydney and Melbourne?
Look, I think that it's well documented that the prices are certainly top-heavy, and from an affordability point of view moving forward, it's going to be a challenge. So yes, I do see that there is certainly room that prices will come back, and we feel, with our finger being on the pulse, that is already starting to happen.
All right, Andrew Fawell, we'll leave it there. Thank you so much for joining us today. Really appreciate your insights.
Thank you.